Hello everyone, and welcome back to another episode. Today we want to make sure that you know how to pay your loans off, okay? You're no longer going to use your checking account to pay your loans off. You're going to be using your line of credit. Somebody asked me the other day, CJ, how do you pay your line of credit in regards to paying your loans off? I mean, aren't these two debts? So first of all, no, they're not two debts, right? Because when you have a credit line, that credit line you can pay and you can borrow from. You can pay and you can borrow from. But from the loan, it only goes one way. Which way is that? Away from you. So let's go ahead and draw these two circles. Okay, this one and this one. Now, one of them is going to be line. This is your line of credit. The other one is going to be your loan. This is going to be your loan. And we're going to get another marker because that one's fading out. So what we have here are your line of credit and your loan, whatever loan it is. It could be a student loan, it could be an amortized loan like a mortgage, which is really a security. And by the way, mortgage means death pledge. Yeah, let that sink in. Line and loan. You're going to be using your line of credit to pay off your loan. Now, what do I mean by line of credit? You're welcome, right? I got your question. What do I mean by that? I mean business line of credit, which can be called a BLOC. I mean a personal line of credit, which can be called a PLOC. I mean a CC, which could be called a credit card. I mean a HELOC, which is a home equity line of credit. I mean anything that a banking personnel or banking organization has given you that has extended you simple interest credit. You need to be specific, okay? Simple interest revolving credit towards you so that you can pay and borrow from the same instrument, okay? Say it with me now. Pay and borrow. Pay and borrow. Now, many of these institutions are slick and they are wanting people to have a scheduled payment. Okay, you need to ask them, and I actually get into this in my class as well, so you need to get it, right? When you're going to these institutions, make sure they're not tricking you. Ask them, okay, what does the payment schedule look like? Okay, this is a trick question towards the banking entities. Why? Because when they say, okay, your schedule looks like, you can say, we don't want that one. Why? Because they're going to say something like, you have to pay $300 a month. You have to pay $400. Well, what if I place more on the principal? No. You still have to pay. Oh, come on now. When you pay the principal down, the payment is supposed to go down on a simple interest line of credit, okay? At least the ones we're talking about, all right? But even if you have that, right, that scheduled payment, you can still work the velocity banking method valiantly. So let's continue on with this, all right? Line of credit. This is what it means. Business line of credit, personal line of credit, your credit cards, HELOCs, okay? Whatever simple interest revolving line of credit, that's what you want, okay? What you're gonna do is once you get paid, now first of all, make sure your expenses are paid out from the line of credit. You can't overload your line of credit. You're welcome, all right? You cannot overload it. So let's say you have $5,000 in a credit limit, all right? You can't place your money and say, you know what? I'm going to go ahead and put an extra 4,000 on top of the 5,000. No, it doesn't work like that. You're going to have to go ahead and spend or invest from this line of credit first so that you have a balance, but that balance will be taken care of by what? Your income. All right. So let's say you spent the balance on this one. Say the credit limit on this one was 10,000. Say you spent 5,000. All right. Well, how's it going to be replenished? With your income. The income is going inside of this line of credit to replenish the line of credit. So let's say that $5,000 goes out and you need to pay it towards the principal. That's right. Towards the principal of this loan. Whatever the principal is, man. Huh? 20,000, 30,000, 400,000. It doesn't matter. When you take care of the principal and you chunk it in a big fashion like that, the interest is going down because the interest feeds off of the principal. You know, I get tickled, man, every time you see a couple and they're like, well, you know, we can't get that house because it's 300,000. You know, even though we're approved for $500,000, I don't want to get the 300,000, the $400,000 house when I could get the 375. Even though they look the same, you know, this one is actually 375 and that one's cheaper. Are you serious? Over a difference of just $25,000, 375 and 400? Folks, you're not buying the purchase price. You're buying the monthly payment. Oh, man. And plus, if you were to implement this, you'd get rid of that not in 30 years, in like 5 to 7 or less, depending on your circumstance. That's why you got to get a hold of this. That's why you must have first lien HELOC banks that we're connected to. You understand? That's why you got to have things like the Money Max account so you don't have to go through that dilemma and delay your dreams. Come on now. Okay, I'm off my soapbox. The income will be going inside of the line of credit, but not before that line of credit has to release. All right, you have to pay the expenses from your line of credit first. And no, for now, you cannot have any direct deposits inside of your line of credit, at least for now. All right, you gotta wait until they pass some legislation. Remember, this is a totally new concept for many people. All right. And so we're going to eventually, our plan is to eventually get this passed up inside of the legislature to ensure, okay, to help people and to help the economy out, because almost no one knows about this method of paying their loans off. All right. And utilizing this line of credit, leveraging it to their advantage and also to build wealth. All right. So look, when you're paying your loan, it doesn't matter the number. Remember, we just went over that. 400, 500, whatever it is, you're going to pay from your line of credit towards the principal. Each month, you're going to have a payment of, let's go ahead and put some number out here. Let's say the loan was $200K at 6%. Okay, you can't see that $200K. Why? Because it doesn't matter. All right, it's 6%. And then the monthly payment is $1,200 per month. All right. So again, the $1,200 a month, you're not looking at the purchase price. All right. You're looking at this monthly payment. Can you afford the monthly payment? Okay. So as you're continuing to pay this monthly payment, when this line of credit is replenished by your income and it's all replenished, so you're back at 10,000, what are you going to do? Are you going to keep the 10,000 there? No. You're going to release another 5,000 towards the principal, okay? And you're going to subtract it. It'll be 195, then 190, then 185, then 180, then 175. And don't forget, you're paying that off as well, right? Each month. Each month. Why? Because the cash flow is there. Now, remember the formula for cash flow. That's I minus E equals C. Income minus expenses equals the cash flow. Where is the cash flow staying? The cash flow is staying in your line of credit. All right? Let's not forget that, folks. That is what is paying down your line of credit. Folks, if you have any questions, don't hesitate. Go ahead and get back with me. Like, share, and subscribe this video all around the world. Listen, darkness is trying to cover the earth, but we're just trying to light it up with this velocity banking method, all right? God bless you, and have a great night.